Hello, everyone, and thank you for joining us today for the second OIC webinar of October, where we're going to compare ETF and index options. Last week, we had a great turnout for the Zero DTE presentation. You've undoubtedly seen a ton of headlines about that topic, but one thing that doesn't always get addressed within that sphere is the options on the ETFs and the indexes and how they differ. Now, when I started thinking about these topics, it became clear that many people wanted to hear about the zero DTE space. But then I started thinking about it and I thought we should also include some discussion about the underlying products where the majority of those zero DTE options are being traded, which is in, guess what? The index and the corresponding ETF space. Today, we're going to dig into that space. We're going to start at the beginning and work our way through many of the similarities of these options, but also into some of the concepts and the key differences amongst them. My hope is that this webinar builds on some of the concepts we covered this year so far and help you to build a mental framework around not only the zero DTE space, but also a more fundamental understanding of how options and optionality works. Once we're able to build that fundamental knowledge base, you're going to be surprised at how many different ways you can apply that understanding, with our ultimate goal here, as always, to be able to help you apply your understanding when you're looking at an options matrix right in front of you, or theoretically in your own mind, and hopefully help you to use what you've learned to make more informed decisions on your own behalf in the options marketplace. My name is Matt Cashman. I'm the Principal of Investor Education at OCC, as well as an Options Industry Council instructor. Quick background on myself. I started trading around 1998. I've been an options trader ever since. I got my start in Chicago on the floor of the CBOE, trading equity and index options. Quickly after that, I moved to London and traded interest rate options there. And then I eventually moved back stateside, where I started and ran an index options market making operation for the better part of about a decade in Chicago. Currently, I work at OCC helping individuals and investors to better understand both the risks and the benefits of exchange traded options through efforts like the webinar you're watching today. We always include a disclaimer to make our lawyers happy. Options involve risk. They're not suitable for everyone. In order to simplify calcs, commissions, fees, margins, interest, and taxes have not been included in any strategy that I discussed, including examples of actual securities, blah, blah, blah. Illustrative and educational purposes should not be construed as an endorsement, recommendation, or solicitation to buy or sell. Past performance, not a guarantee of future results. Look at all those happy lawyers over there. The following trademarks, logos, and service marks are displayed and wholly owned by the Options Clearing Corporation. You will see them used throughout the presentation today. A quick bit about the OIC. OIC is the Options Industry Council. It's the educational arm of our parent company, the OCC, which is the Options Clearing Corporation. OCC is the largest clearing corporation of equity and index exchange traded options in the world. OIC started out as a collective in 1992 to better educate the public as to the risks and benefits of exchange traded options. Currently, we continue to pursue that goal mainly through the utilization of our website, which you can see right here, optionseducation.org. There, you're going to find online courses, podcasts, videos, webinars like the one you're listening to and watching now. We're able to provide these services free of charge to the public because we're fully funded by our parent company, the OCC. One other thing I want to really bring and highlight is options at the OCC. This email address right here is really an underutilized asset for the investor out there, I think. If you have options questions, please send them to options@theocc.com. I work on a fantastic team of people at the OIC called the Investor Services Desk, or the Investor Education Desk. I sit on that desk with 3 other colleagues, and this email address goes to a shared email box amongst the 4 of us, where we answer questions from investors that come in every day, all day long. One thing that's important to drive home here is that we are not registered investment advisors. So we cannot give you investment advice. We can't direct you on trades or suggest investment strategies, but what we can do is help you with general knowledge about optionality and how options work. This fantastic team, the Investor Services Desk, is represented today not only by myself, but by my colleague, Ken Keating, who is in the background running Q&A today. He's going to be answering your questions back there. He's back there all by himself today. Usually there's two of us, but today he's back there by himself because we have a lot of members of our team traveling, going to different places. I'm actually getting on a plane and going to Orlando tomorrow for the Money Show. But a lot of times questions come in at the same time. Please be patient. If a lot of questions come in at the same time, he's going to do his best to get to them all. But also, if you don't get your question answered today, make sure to send us an email at options@theocc.com. It's a free service that we provide to the public, and we love to answer your questions. We're happy to help in whatever way we can. Let's get started. We've got a lot of ground to cover today. I always use this slide whenever I start a presentation. It's annual options volume from 2000 to 2023. As you can see, things have absolutely exploded, not only in breadth, but in depth. There are more people involved, and they're more involved on a day-to-day basis, trading more often and in larger size than have ever been in the past. Many times I reference 2008 when I'm talking about this because I was literally standing in the SPX pit on the floor of the CBOE, looking up at the board at the end of the year and seeing 3.7 billion contracts across the tape as the end of the year volume number that was cleared volume by OCC. That was the craziest thing I had ever seen as far as not only volume, but also as far as volatility is concerned. In contrast to that, last year we did 11.2 billion contracts. And since 2020, you've seen volume numbers since 2019 actually double. This is important from our seat because as options educators, it's our job to make sure we give you as much unbiased information as possible so that you can make good investment decisions with options. Make sure you do your own research and think about how options work. We're here to help support you and give you as much information as we can, but we want you to think about how options work as well before you start pressing buttons and buying and selling options out there in the market. Let's make sure we do that today. Here's what we're going to talk about. Remember, comparing ETF and index options. Where do we have to start? We got to start with what's an index. Index options compared with equity and ETF options. One of the big ways they're different is their cash versus physical settlement. We'll talk about that. We'll also talk about European versus American style exercise, which is another way that they actually are different. And we'll talk at the end about about indices as portfolio protection tools. That's one of the things that we're going to touch on at the very end, which I hope will give you some actual actionable ways to think about using index. So let's start at the beginning. What's an index? Stock indices generally are meant to be broad market indicators. What that means is that they represent a collection of stocks. It's a way to gauge and look at the broader marketplace in one price. And so they really exist for informational purposes and not to be traded directly. That's in direct contrast to something like an index fund or an ETF. Those are actually meant to be traded and changed hands directly one by one. But indices are actually made to be just a representation of the marketplace. Now, in the United States, there's three big indices that we talk about all the time. As you know, the S&P 500, the NASDAQ 100, and the Dow Jones Industrial Average. These are three of the biggest. There's more of them out there, obviously, but these are three of the biggest and most commonly used indices when we're talking about how these things represent the broader market. So let's think about what these look like on their own, because they're slightly different. S&P 500 is 500 of the top companies in the U.S. It represents approximately 80% of the total value of the U.S. market, and it's widely used as an indication of movement in the U.S. market. Many times you will also hear people who are, let's say, professional or kind of semi-professional traders refer to the S&P as the SPOOs. We talk about them as the SPOOs. Where are the SPOOs? Oh, they're up 50. Where are the SPOOs? People will call them the SPOOs as well as the Standard & Poor or the SPX as well. NASDAQ 100 is a large cap growth index. It is 100 of the largest companies listed on the NASDAQ. And what you're going to find in the NASDAQ is industrial, tech, retail, telecom, biotech, healthcare, et cetera, et cetera. There's not financial stocks like legacy financial stocks in the NASDAQ like there are in the S&P. The last one is the Dow Jones. It is 30 of the largest companies in the United States, really the oldest and the most well-known of these indices, represents about a quarter of the value of the entire U.S. stock market. Now, there's really two different ways that these indices are calculated and or put together. One of them is market weighted and the other one is price weighted. What's the difference between them? There's really a big difference in how these things actually move around based on the components that are built into them. And the difference is in the market weighted or the price weighted way. Market weighted indices represent the total value of each company's market cap. So how do you do market cap? Basically just take the price of the stock and you multiply it by the number of outstanding shares. Thus, a company with 20 million shares selling at $50 a share is going to have a market cap of $1 billion. The S&P 500 is a market weighted index. The NASDAQ is a market weighted index. However, the Dow Jones is a price weighted index. Price weighted indexes represent the average price of the stocks contained within the index, essentially. And so there's a difference between how they are weighted. Price weighted indices give greater weight to stocks with higher prices. They don't do this on purpose. They just do this as a function of how the math works. If there's 10 parts of an index and it's price weighted, and one of the stocks is trading 50 and the other are trading 10, when the $50 stock moves around, it's going to move the index around more because it just is a larger part of the overall number of that index. The Dow Jones is a price weighted index, and thus higher price stocks move that index more than those with lower prices within that index. I hope that makes sense. One other thing that you need to think about when you're thinking about indexes is that because they're not tradable, they're not really tradable back and forth, the actual underlying itself, when they're not, since they're not directly tradable, what have we done to make sure that people have exposure to them? Because indices are great ways to get exposure to a broad marketplace. Well, what's happened is lots of different financial products have been developed over the last 30 to 50 years to give people exposure to these indices. And so investors and speculators can trade index options to get exposure to the entire market in one trade, one place. It's a really great way that this market has developed over time to actually allow people to trade these indices without the actual indices changing hands because they're not directly tradable. So that's how the actual market has developed over time. Let's talk about ETFs and equity options relative to index. One of the things that I like to think about when I think about options is how are these things similar? And really, index options are similar to equity and ETF options because they all really possess the same basic optionality. When you're buying calls or selling calls or buying puts or selling puts, you're actually still holding on to the same rights and obligations within these ETF and index options that you are if you're trading stock options. If you're someone who has traditionally only traded stock options and hasn't traded index options before, don't be afraid of that space. You need to educate yourself as to how they work, and then actually you can apply many of the same concepts of optionality into the options because the options are similar across the board. Now, the notional value of an option contract can be determined by multiplying quoted premium, how much the option is trading for, by the multiplier. Generally speaking, the multiplier is 100. We're going to get to this little bit later on when I give you some actual examples of how this works. But commonly, the factors that affect these option prices in indexes and ETFs are the same as you would find in an equity option. They are the value of the underlying instrument, which in this case is an index, the strike price, the volatility, the time until expiration, interest rates, dividend yields by component securities, so things that are built into these indexes and the dividends that they pay. A lot of what you're going to see here is very similar to how equity options work, but there are some key differences. The differences are really threefold, and that is the method of settlement, the exercise style, and the delivery. This is where you're going to find differences in how these options trade relative to something like an equity option. Now, the method of settlement can be AM or PM. That's the big difference there. That means it's going to either settle to all the prices, the component prices of the index that happen in the morning, or component prices of the index that print on the close in the afternoon. The exercise style, European versus American. European options can only be exercised at the moment that they expire. I'm going to say that again. The big difference here between European and American style options, the European options can only be exercised at the moment they expire. American options can be exercised at any point during their life cycle. That's why you get things like early exercise premium built into equity options and places where there are American style potential early exercise risks that are in there. American style options can be exercised at any point during their life cycle. European options can only be exercised at the moment. The deliverable can be different. A physical deliverable is essentially shares of stock. If you're trading equity options, your physical deliverable is 100 shares of stock per option. If you're trading index options, your deliverable might be cash. These might be cash settled options. Make sure you pay attention to how these options are delivered. It's important to have an idea of what the option is going to turn into when it eventually doesn't exist anymore. Sometimes it's cash, sometimes it's an actual physical underlying. Now, in the case of the indexes, there's no physical underlying to actually turn into. So many times those index options are cash deliverable options. That is why they are cash deliverable options, because they couldn't deliver the underlying even if they wanted. ETFs then have corresponding tickers and exchange traded funds that correspond to these indices. So ETF stands for exchange traded fund. It's essentially an index fund that's listed and traded on an exchange like a stock. An ETF is a basket of stocks that reflects the composition of an index. So when you buy an ETF or sell an ETF, what ends up happening is that they take your cash and they create shares of the ETF by going and buying the component pieces of it. They hold your cash, they give you the share, which represents your kind of arrangement with them as far as the however many component pieces of the ETF there are. In the case of these large indexes that trade in the United States, many of them have corresponding ETFs, and you can see them here. For instance, the SPX has a corresponding ETF, which is the SPY. It's managed by the trust, the SPDR S&P 500 ETF trust. And the contract size of these ETFs is generally much smaller than the full index size. In the case of the SPX, the SPY, or the SPDR as we call it, is 1/10 of the SPX. In the case of the NASDAQ, the ETF that corresponds to that is the Qs, the triple Qs. The trust is the Invesco Triple Q Trust, and the size of that ETF is 1/40th of the NASDAQ. In the Russell, it's the IWM, it's 1/10 of the Russell, and in the Dow, it's the DIA, which is 1/10 of the DJX. It's important to remember this contract size is oftentimes much, much smaller than the index itself. Important to remember that because this is going to play a large part in how the notional value of these options is computed as well. Talk about cash versus physical settlement, because this is a big difference, especially in the index. Significantly different settlements here between cash and physical settlement and between ETFs and indexes. Start with the ETFs. On the product side, you have these stock ETFs that look a lot like stocks and act an awful lot like stocks as well. Some of these ETFs, because they are corresponding ETFs to indexes, have these expirations that exist in the indices 5 days a week. You've got 0 DTE options, you've got weekly options. The expirations sometimes will be 5 days a week. Most of the time, their settlement is going to be on the close. These are closed settled products, and their deliverable, this is the important part, is generally the underlying stock or ETF. It's like trading a stock that represents the index, the corresponding ETF that represents the index. You can imagine that the reason why people created these is because some people actually couldn't trade indices and the options on the indexes. And so this is a way to allow people to trade and to have access to these products at a reduced size. Remember, many times they are like 1/10 or 1/4 or they're smaller size multipliers, and they act a lot like stocks. People understand them more intuitively because they've traded stocks their whole life. On the flip side of that, you've got indices. Some, again, of these indices have expirations 5 days a week now. Their settlement is derived from the last sale price in the primary market for each of the components of the basket stocks. This is really important because many times their settlement can be PM versus AM, and you need to understand which one is which. Tell you a little story about that and explain why that happens. It's specifically in the SPX. It's an interesting part of the product itself, but pay attention to when the actual options settle. Can be PM, can be AM. And generally speaking, these options settle most of the time. And like I said at the beginning, if you think about it and the actual index itself is not tradable and you can't settle the options to an underlying, they have to settle to cash. That's part of the reason why that exists in that way. All right, let's talk about cash settlement value here, because index options have two distinct option settlements. The weekly options expire generally in the PM, and they derive their settlement value using reported closing prices of each of the component stocks in the index on the primary exchange. The monthly or standard expiration index options stop trading on Thursdays and expire Friday morning in the AM. The AM expiration settlement price is determined using the opening print from all of these, for instance, 500 shares of stock or 500 largest stocks that are in the S&P 500. Many times that symbol will have its own symbol. In this case, for SPX options, it's SET. Now, when I was trading cash settled S&P options, they would expire on the third Friday of each month. Those were considered standard expiration options, but they wouldn't print. You wouldn't know what the actual print value was until the Friday morning when you came in. As you can imagine, this can create quite a difference if there are especially events that happen overnight, or if there are particularly illiquid pricing structures that exist in the marketplace. The interesting part about this is that sometimes you could be trading these options and waiting overnight for an idea as to how the actual cash is going to print. Many times we would come in on Friday morning, and if you're carrying expiring options into what's called the print in the S&P 500, what you're carrying is options that have corresponding delta, gamma, and theta of that overnight period between Thursday PM and Friday AM. And you usually would have futures against them. You have SPOOs against them. Now, the options themselves expire at some point, but the futures that you're carrying against them do not expire. And so what you have most of the time would be delta from the options that are expiring, which is expiring delta the next morning, and you have futures that don't expire against it. Sometimes you would get events where, for instance, 1 or 2 or 10 or 15 of the 500 stocks would print on the open significantly away from where it settled the night before. That's going to affect an AM print. It's going to affect the cash price of the index. However, it might not affect the futures in the same way. Sometimes what you get is a big difference between those two things. Sometimes those differences can create a lot of, let's call it opportunity and or the flip side of opportunity, which is not always great. The difference between the cash print on Friday morning and the PM settlement on Thursday can often be a big deal. And it's something that you need to keep in mind if you're going to trade those monthly expiring. The settlement is based on the opening price of that day's expiration. Like I said, AM settlement. The settlement value is derived by using the opening price of all those stocks that are opening one at a time. And the reported price has a settlement symbol, as opposed to these PM settlements that do not have a settlement symbol. Here is a list of those settlement symbols. So in the SPX, you have SET. That's the settlement symbol. That's going to tell you the actual cash value, the cash settlement price on the Friday morning. In the NASDAQ, it's the XQO. In the Russell, it's the RLS. And in the DJX, it's in this case, you're going to get the last trade day is Thursday, but the expiration day is Friday on the AM print. All of these stocks open. It can be a significant difference. It can be something that creates a lot of consternation in the options market. Pay attention to it. If you're holding options into that print, you need to know what your risk is. Let's take a look at a cash settlement example here. With cash settled options, no stock is delivered or called away as an option expires to cash. So cash settled options transfer only the intrinsic value to the holder when they're exercised. The difference between settlement value and the strike price of the option is that works. So in the case of a long in the money call, let's say you're long the 4190 call, and the set value the next morning comes in at 4200. So the set value is the cash print of the index minus that strike, 4190. That's going to tell you that call's worth $10. In the case of that option, the multiplier might be 100, and the result might be $1,000 of cash credit on the expiration of that option. Let's look at a short out of the money call example. If you're short the 4210 strike and that same cash print comes at 4200, the option writer, the person who sold that option, keeps the entirety of the credit, because guess why? That cash settled option goes out worth zero. It actually prints zero because the difference between the strike and the value does not yield any intrinsic premium. It has no intrinsic premium, it has no intrinsic value, and thus it goes out. All right. Let's talk a little bit about European exercise, because many of these index options are European exercise. European style options only allow for option exercise at the moment of expiry. At the moment of expiry. Index options, generally speaking, are European style, except for a long time ago, the OEX was an American style index option. They only can be expired at expiry, and equity options, for the most part, are American style options. They can be, you can exercise American style options during the entirety of the life cycle of that option. When we talk about European versus American exercise, there's a couple of things that you need to keep in mind. The first one is what I have already driven home. That point is European style exercise options can only be exercised at the moment they expire, and American style options can be exercised at any time during their life cycle. One thing that we get a lot of questions, I think is important to drive home as well. If you're trading European style options, that doesn't mean that you have to hold the position all the way until it expires. Trading European style options doesn't mean you're stuck in the position. Positions can be closed, added to, or you can do all of the things that you would normally do with American style options with European style options, with the exception of early exercise. You cannot exercise them early, but what that means is that you can trade in and out of these options just like they were American style options. It's important to remember that when you're trading these options. Okay, we've gone through the differences between ETFs and indices. We've gone through the differences between cash and physical settlement. We've gone through European versus American style exercise. Let's talk about some of the ways that people actually use these index options as portfolio protection. Because this is an interesting part of how people use them. One of the reasons why people love these options is because they're versatile. They give you the opportunity to trade on the broader marketplace. It's an easy way to get exposure to an entire market or a subset of a market through one single transaction. One thing that you need to keep in mind when you're thinking about indices is because they are a broader market indicator, really, what they do and how they act tends to have a slightly lower volatility profile than options on individual stocks. This is where you may have heard people talk about the dispersion trade. That's what the dispersion trade is. Dispersion trade is actually trading options on individual names of an index and then trading index option premium against that. Many times, index option premium is underpriced relative to its component pieces, and it has lower volatility numbers based on how much things move relative to how much the actual pieces of the index round. So, volatility around earnings reports, mergers, other news events can really move stocks around. But what you're going to see most of the time, it's not always the case, but most of the time, you're going to see index options have a smoother volatility profile than those individual options on individual stocks for that. Take a look at some potential examples of index option strategies. Basically the same strategies that you're going to see when you're trading equity options. You might be bullish on something and you might want to buy an outright index call. You can do that. That's the same thing as buying a call in an American style equity option, with the exception that you're probably going to be buying an index call that is cash settled, and it's going to expire. It's only going to be exercisable at the moment of expiry. It's probably going to be a European style option. If you're bearish, you can buy outright index puts, just like you can in an actual stock, if you're anticipating the underlying index to fall. or you can use it for protection, buying index puts. Sometimes people use this to hedge portfolios as an index insurance strategy, a way to actually buy protection in a larger, broader market index against another strategy that they have somewhere else. Let's take a look at one bullish example. We're going to talk about the NASDAQ here, a long call example in the NASDAQ 100. Now, this example came from a little bit ago when the NASDAQ was trading 12.7. I think it's trading closer to 20,000 now. Let's pretend like the index, let's call it the index, is trading 12.7. You're bullish. You decide to strike the call strike, decide to buy the call on the 13,250 line. And that call costs $100. It has 90 days to expiration. It's a 3-month call. Doing the notional math here tells you that the $100 price tag for that option times its multiplier of 100 means that each one of these contracts costs you $2,000 in notional value. That means that the break-even point on this trade is going to be 13,250, your strike, your call strike, plus the $100 that you're paying for that call. Your break-even on this trade is going to be 13,350. Now, let's say at expiration, your index is trading 13.5. The proceeds on this trade are going to be $25,000. Where do you come up with that? 13.5 is where the index goes out, minus your strike, 13,250. It's going to yield 250 times the multiplier again. Don't forget, that's how you get the notional value, is going to give you a notional value of $25,000. You already paid 10 grand for it. So profit in this case is going to be 15 grand, 5K that it's worth notionally at expiration, minus the 10 you paid for it. What does this look like from a P&L perspective? It looks an awful lot like a long call in any of the equity options that you would trade. In this case, the index is meant to be shown here in green. This is your index value. You bought the 13,250 call, remember, you paid $100 for it. That means your break even is 13,350. And your $100 is the most that you can lose for it here. Anything below that, that call is going to go out worthless. Anything above your break even, it's going to have some amount of intrinsic value, which will be represented by cash settled price of that index option. And it's going to settle to a cash number. And then that cash number can be deducted from what you paid for, essentially. Let's look at one other example. This is going to be a bearish example. Again, the NASDAQ 100, we're going to put it at the same price, 12.7. But in this case, it's the put strike, the 12,150 puts. The index option premium is going to be $100, and you've got 90 days to expiration. Again, the contract costs 10 grand because it's a $100 price tag times its multiplier of 100. The break even here is going to be calculated similarly, but in the opposite direction. It's your actual put strike minus the $100 that you paid for the option. 12,150 minus 100 gets you to a break even of 12,050. Let's pretend at expiration that the index settles 11,950. In this case, proceeds again are going to be 20 grand. That is 12,150 your strike minus the settlement price is going to give you this intrinsic price of this option at settlement at expiration is going to be 200 times the 100 multiplier to get your notional value of 20 grand. Again, you paid 10 for it. It went out worth 20, your profit is $10,000. This again looks like a regular put would in any index, in any, equity option that you would trade. Those bearish examples, same thing in the index as you would in the equities, except for the fact that you have this cash settlement process. Keep in mind, it's important to think about when do these options settle, how do they settle, and what do they settle to? Those are the things that you always need to keep in mind. And that's true when you're trading any option. Now let's look at how people use these as protective put strategies. In this case, you might want to buy protection on the broader index because you're long lots of things in other places. And investing in protective puts is meant to safeguard some of your portfolio against downturns without sacrificing the components of the portfolio. One of the things that people like about index options is that it allows you to actually profit from a downturn in the market without having to necessarily sell your underlying holdings. And so that's why people use these for protective put purposes. If the index falls below that long put strike, just like the example I gave you in the NASDAQ put that you were long just now, an increase in the notional value of the put is going to theoretically offset the notional losses on the portfolio from the market decline. The inevitable question is, how much protection do I need? If you want to protect, for instance, $1 million portfolio, you want to protect 100% of the portfolio, you're going to need to essentially buy the at the money option in the index because you're going to want to protect 100% of $1 million of the portfolio. That means the difference, the value between the index level and the strike of what you're going to strike that put at is basically no different. You're going to be buying the at the money put. If you want to protect 80% of the portfolio, you can do the math. 80%, $1 million portfolio, you want to protect 800 grand of this portfolio. That means the difference in the value between the index level and the strike price of where you can strike that put is about 200 grand in notional value. Again, you can do the math here. Protecting 30% of the portfolio, you're going to want to protect 30%, it's going to be 300 grand. Difference in the value there is going to be 700 grand from that $1 million portfolio. So how does that look from a strike and a time frame perspective? Let's now pretend you have 1.2 million invested in lots of things. And you have a mindset that things are going to get nasty over the next 6 months. If you want to protect 90% of your portfolio value, you're looking at $1.08 million. And then let's also pretend the underlying index is trading 4,100. So doing the notional calc on the actual index, use the multiplier of 100, and you get a notional value for that index of $410,000. That's how much the notional value of the index is worth for 1 month. Then, if you wanted to protect 90% of your portfolio value, you could say 90% of the $410,000 notional value would be $369,000. You could look for a close strike price to that. You might find the 3,700s. 3,700 puts would get you to $370,000 of notional value if you use that 100 multiplier to get to notional value. And if you wanted to protect all of or almost all of that, you could buy 3 of those puts, 3 of the $3,700 puts, times that 100 multiplier is going to get you 1.11 million of coverage if things went to zero. The 3,700 strike put with 6 months to expiration might cost you something like $120. Doing the notional value there, cost of protection would be 36 grand. That's 120 times 3 times the 100 multiplier. So each one of those puts is going to cost 12 grand. 3 of those puts total is going to cost you 36 grand, or essentially 3% of the value of that $1.2 million. One of the things that people ask is, how do I know how much of this I need? And if we talk about this from a 90% of the portfolio for 6 months, and you're buying 3 of those 3,700 puts, you're spending 36 grand on protection. And you might want to ask yourself, is that commensurate with my view on the marketplace going forward, especially over that time period? Because that's what you're really getting here. You're getting 6 months of coverage for 36 grand. And if you think that that's really what you want, then yes, buy the puts. But you could also move it to a shorter term option, which is probably going to cost a little bit less. Remember, time and price are usually correlated. The more time you put into an option, the more the price of that option is going to be. Or you can select something like that might give you less coverage, less protection by buying lower strike puts or buying less of them. Really a give and take process as to like how you want to protect that, how you might use them. There's no perfect calculation as to exactly what strike to use and exactly how many of them. What I tried to give you here was like a framework to be able to think about notional value of the index itself and how that might correlate to how you might want to hedge a portfolio of a differing notional value than the actual. So let's talk about a little bit of a summary here, and then we'll get into some Q&A. Stock indices are generally not traded. You cannot trade them back and forth. And thus, thus what we have done is really created these kind of options on these indices to allow people to actually trade them back and forth without trading the actual direct underlying, which in many cases does. Now, indices are either market weighted or price weighted. Remember how we talked about that? Similarities of these indices is that, or of these options, is that the pricing of the options is very similar across the board, and you're going to get the same types of optionality based on, the optionality is really fungible across all of these options. But the differences that you're looking at are settlement, which is AM, PM, European versus American style options, and what it delivers. When do these settle? What do they settle to? And when am I allowed to actually exercise these options? Those are the things that you need to keep in mind when you're trading these. And then, of course, you can always be bullish, bearish, or use them for protective purposes, just like any other option out there. The index and ETF space is not that different when you really think about the optionality that's incorporated there. It's very similar to the optionality that exists in the equity world. The thing that you need to pay attention to are these differences that we highlighted here. When do they settle? What kind of settlement style are they? And what do they settle to? It's important to keep that in mind when you're trading. So, Ken, how are you doing? And are you there? Might be on mute. Or you might not be there at all. Okay, I will take some questions. Let's see. Andre says, is there visibility on order flow? The same visibility that exists in equity options is going to exist in the index and like ETF option space. You're not going to be able to see anything differently in the index and ETF options that you don't see in the equity options. The one thing that you are probably going to see is that there's, generally speaking, just more size that trades in these index options. The actual size is, and the reason why is because in the indexes, they are really catering to a more institutional size client. And so institutional size is a lot bigger than the actual retail size. The reason why these ETFs started to trade in the way that they do, like SPY, and because they made the actual contract specs, the multiplier 1/10 the size of the actual index contract, is because they wanted to incentivize people that were retail traders to be able to trade them. So they have less premium. They actually, they're less capitally intensive to trade. So you might think about the fact that you're going to see some larger size because it's an institutionally sized product when you're trading the indices options before you. Let's see. Andres asked another question, another good question. What is the effect of dividends on index? Well, Dividends on index options are an interesting question. And one of the things that many people will track and talk about is, for instance, the dividend yield on something like this. The way that that's going to play out, and the way that you're going to see it play out in front of you, is in something called the roll. The roll is essentially a way for the futures contracts to represent a forward price for the index over a certain amount of time. If you think about the fact that the 500 stocks that are within the actual index all are, some of them are paying dividends and some of them are not paying dividends, you're going to get a certain amount of dividend that's going to be paid theoretically through that period of time. And so the actual future will be discounted by that amount over that period of time. And so as you're looking at the futures curve on something like the S&P, you're going to see that built into the way that the curve is actually priced. You'll see that then in the options on those futures because they're priced at different points during the day. I may not have explained that perfectly, but if you want a further explanation, send us an email at options. And we can talk about that. Which ones, ETFs or index options, historical volumes are bigger? Well, that's a really good question. I would think because of the fact that the ETFs are sometimes 1/10 or the size, they may have actually bigger volume numbers. But if you do the notional value calcs, they might come out on the other side. Indexes notional. Is it not better to buy with long duration on the long put side, greater than 120 days for protection, and when the protection is not required, sell the put? It's a good question. The strange thing about that is that oftentimes this is really a function of when you need the actual protection, how long you need the protection, and how much you're willing to pay. It's really a function of your risk tolerance and your investment strategy. It's not really something that I can point to and say it's better to buy long puts in longer duration than it is anywhere else on the curve. That's going to be a function of how you want to invest, where you need protection, how much you're willing to pay. Really how we answer this always. One other question is, why are you not hedging by selling shorter dated and buying longer dated to offset notional costs? That's a really good question. What this person, Mike, is talking about is the concept of a time spread. Time spread is trading two differing duration options against each other as a strategy to, there's lots of different ways you can look at it, but one of them is exactly the way that he describes it, which is that you're trading one option versus the other, inclusive of the duration difference between them, in order to offset the cost of the entire trade, because you're buying one and selling the other. It is certainly possible to trade time spreads in index products. It happens all the time. As a market maker in these products, I traded time spreads constantly. It was a huge part of how we made our money as market makers, to be honest, was the difference between the fall surface between December options and March options, or June options and July options. Those things are traded back and forth all the time as time spreads. If you want to talk more about time spreads, feel free to send us an email question about time spreads. We will talk to you until you're blue in the face about time spreads. But yes, time spreads are traded in the indexes as well. Let's see. How is the spread justified between the bid and ask? That is a great question. Bid-ask spread is a function of supply and demand. It is a function of how many people are out there making prices and how tight they're willing to make that price. If you think about the fact that as a market, your job is to provide liquidity, and in return for that liquidity provision, you are paid essentially, theoretically, the bid ask spread. The bid ask spread is going to be a function of how much people can expect to make by trading those options back. And so, in situations where you'll see extremely volatile environments or highly illiquid markets, you're probably going to see a wider bid ask spread because of that. What that is the marketplace essentially telegraphing to you that they're expecting to be compensated more for taking the same commensurate amount of risk by expanding the bid ask spread. Now, no one gets into a room and talks about what the bid ask spread is going to be. That just doesn't happen. What happens is people will post, and if you and I are making markets and you are someone who wants to sell the options, I'm someone who wants to buy the options, because of the fact that you're going to be more incentivized to lower your ask price for these options and sell them, and I am incentivized to actually buy the options and thus raise my bid, we might create a market between my bid and your offer that might be exceptionally tight. That is what we're talking about when we're talking about the distance or the spread between the bid and the ask. And that's why when I answer that question, I say it's really a function of just supply and demand. Do I want to buy the options more than you do? And do you want to sell the options more than I do? You're probably going to be on the offer. I'm probably going to be on the bid. And that might be an exceptionally tight market. However, if the underlying that we're trading has been moving around 4 standard deviations every day for the last 6 weeks, neither one of us might want to trade either one of those sides of the option. And that spread might be a lot wider than it would be in a situation where the underlying didn't move around very much and you were incentivized to sell the options and I were incentivized. So that's kind of how the spread between bid and ask works most generally. But again, if you have questions about that, you can send us email questions at options@theocc.com. Let's see. One last question, I think. How about this one from John Ford? John, could you go over the dispersion trade again? Sure. So the dispersion trade is, I want you to think about this. I'm not going to, like, the dispersion trade generally is this. Let's say, if you're trading the S&P 500, the S&P 500 has 500 stocks in it. And the S&P 500 options have a certain amount of premium that is associated with them that is then associated with how much the S&P 500 index is moving around. If, for instance, you thought that there were 3 to 10 specific names that had a lot of potential to move independently over the next 6 months, and you had a directional bias on those names, you might go buy options in those 3 to 10 names independently and carry those 3 to 10 long option positions or short option positions, whatever you have there. You might go buy optionality in those specific names. That doesn't really create a dispersion trade all on its own. The dispersion part of the trade comes when you say, okay, I just spent $1 million in premium on all of these 3 to 10 option strategies that I think are explicitly in those specific names that happen to be a part of the S&P 500. Now, against that, I'm going to go sell $1 million of S&P premium in the options against it. And thus what you end up with is someone who's long a lot of individual stock vol, right? You're long option vol in individual names. And against that, you are short index vol. You're short options in the indexes, you're long option in the component pieces. And thus now what you have is what we would call a dispersion trade. That's where the name for the dispersion trade comes from. There's all kinds of metrics that people go into when they're trading dispersion. And it's a really interesting part of the marketplace. It's also fairly complicated. Lots of hedge funds trade it very aggressively. And the SIBO has a lot of information on the dispersion index that they've just released recently. That's great. And Mandy Zhu does a great job from SIBO explaining things like that. Go check out the SIBO website. It'll have information on the dispersion index. One last thing here, optionseducation.org. Thanks to everyone who has joined us today. Make sure you check out all of our options educational resources at optionseducation.org. We host all of our educational resources there. And again, send us emails on options@theocc.com. It's a fantastic resource where we answer questions in the options ecosystem every single day, all day long. Fantastic resource that we provide to the public because we're fully funded again by OCC, our parent company. And we're not registered investment advisors, but we love to help you out with options knowledge and help you build your options way. If you like what you have seen today, make sure to come back on Nov 13th, which will be the first OIC webinar of November with my colleague Roma. Many of you may know Roma. She's going to go over the VIX and talk all about the VIX. I saw lots of questions about the VIX today when we're talking about indexes. Roma's going to cover the VIX in November. Again, that'll be November 13th. Same bat time, same bat channel, 3:30 p.m. Central on Nov 13th. Make sure to come back and check this out. Thank you very much for joining us today. I hope you have a great day. I hope you enjoy.